Welcome to AION Powerhouse, the deep dive. Today we're not going to tell you where the bottom is. Nobody can. Bitcoin just broke $60,000, testing its 200-week moving average for the first time this cycle. Everyone wants the date and the price. The allocator's job is different. Build the MAP of where the bottom probably is, and the checklist of what has to confirm before you re-enter. Today we draw that map from the data.
Right, and that map is frankly desperately needed right now. I mean, if you're an investment committee sitting down this Monday morning, reacting to the day-to-day noise of red candles so capital gets absolutely destroyed.
Yeah, exactly.
We really have to just strip away the emotion here and look at the structural reality of the market.
So looking at this map, we are essentially standing at the edge of a cliff today. Like, testing the 200-week moving average isn't just some technical glitch. It's a massive event. So let's define this first, right? Because it's the anchor for literally everything we're about to discuss.
Yeah.
So the 200-week moving average, that is the average price of Bitcoin over the last roughly 4 years. It's an incredibly slow-moving line.
Right.
And the critical context here for the listener is that in every single prior cycle, Bitcoin has only touched this line at moments of absolute peak terror. So it's not a day trade signal. Historically, it is the cycle's structural floor, the definitive bottoming zone.
Yeah, because it represents a full 4-year halving cycle of data. So when price compresses all the way down to that level, it means the tourists have entirely washed out.
Right.
And historically, that is where the long-term believers, the foundational buyers of the network, finally step in to defend the asset.
But that defense is kind of buckling as we speak. I mean, Bitcoin is testing roughly $60,000 today. It's down another 2 to 3% on the session, and it is actively dipping below that 200-week moving average, which currently sits right near 62,000. This is the very first time this entire cycle we're seeing a tag of this line. And let's frame the drawdown here. And by drawdown, we mean the drop straight from the cycle's peak.
Right, the peak to trough.
Exactly.
Yeah.
So Bitcoin is down roughly 52% from its peak of roughly $126,000 last October 2025.
And I know, look, a 52% haircut feels catastrophic if you're looking at your screen, watching Q1 gains just evaporate. But we really have to look at the underlying mechanics driving this.
Well, the mechanics are grim right now. Let's rattle off the catalyst. The fear and greed index is just pinned in extreme fear. We've got a record-breaking stretch of ETF outflows. I'm talking a staggering $3.4 billion exit in a single week.
Which is insane.
Throw in a hawkish Fed that just signaled they might actually hike rates instead of cutting them, and, a broader AI and semiconductor equity sell-off.
Yeah, risk assets are just being dragged down across the board.
Mm-hmm.
But let's pause right there. This is why we have to elevate this artifact, the 200-week line. You cannot treat this as just another support level on a chart.
Right.
It is the closest thing this asset has to a true valuation anchor. If the price touches this line and it holds, history says you are looking at a generational entry point.
The asymmetric bet.
Exactly. The risk reward is asymmetric in your favor. But if the price pierces this line and just keeps falling, it signals a regime change. It tells you that the structural demand that saved every past cycle simply isn't there this time.
The invisible hand just disappears.
Right. So the question for an allocator isn't, is 60,000 the absolute bottom? That is a fool's errand. The true question is, what does the full synthesized data set tell us about whether this floor actually holds, and what are the specific signals that will warn us if it breaks?
And I want to challenge an assumption right here, because it's a trap I see a lot of allocators falling into. The assumption is, well, we're already down 52% from the highs, so surely we must be close to the bottom. Like it's cheap, right?
It's a very natural human bias. You see a half-off sale at a premium retailer, and your gut says, oh, it's a bargain. But is the data actually supporting that instinct?
Well, the data says exactly the opposite.
Right.
So here is the reframe, and we are pulling this from Benjamin Cowan's cycle work, which is arguably some of the cleanest macro analysis out there. We need to look at midterm year seasonality.
Yeah, this is crucial.
To define that clearly for the committee, midterm year seasonality refers to the highly repeatable pattern that risk assets follow during United States midterm election years.
But let's explain why that happens, though, right? Because it's not just a random calendar coincidence. Midterm years introduce massive regulatory and tax uncertainty in Washington. And when institutional capital doesn't know what the tax code or the regulatory environment will look like in 6 months, they don't gamble. They retreat to cash.
Yeah.
That retreat creates a liquidity vacuum, and when liquidity drains from the system, risk assets like Bitcoin just bleed out.
And that mechanism explains the math perfectly, because if you overlay the average price action of prior midterm years, Bitcoin is normally down about 45% from its yearly open at this exact point in the calendar.
Right.
But right now, it is only down about 31% from the yearly open.
Wait, really think about what you just said?
I know, the uncomfortable truth. Measured against its own historical bear market template, Bitcoin is not oversold.
Wow.
It is actually outperforming the average.
Yeah.
It is doing better than it usually does during a midterm year liquidity drain.
And that is a vital distinction for an investment committee to grasp, because the move that feels like painful, agonizing capitulation right now is, well, statistically speaking, still mild. Less down than usual does not mean cheap enough to buy. If Bitcoin were to simply revert to the mean, to follow its typical midterm path, the price would drop closer to $50,000, or maybe even slightly below that.
So the true washout, right, the drawdown that completely breaks retail psychology, the one that makes people swear off crypto forever.
It hasn't fully materialized yet.
Exactly.
It hasn't, and you really have to understand the historical path to these macro bottoms. The market rarely gives you a single clean drop where the price V-bottoms on a Tuesday and just takes off to new highs on Wednesday.
Right.
It is a grueling sequence designed to exhaust capital. Historically, you get an early summer low, then you get a frustrating, choppy counter-trend bounce in the late summer that traps a lot of eager early buyers who think the bear is dead, and then you get a final, soul-crushing leg down into the fourth quarter.
Which brings us to Cowen's base case. His model points to the ultimate low occurring somewhere around October.
But we have to explicitly include Cowen's own caveat here. He is adamant that you never marry a date.
Yeah, that's key.
He notes he would abandon that October target instantly if a sharp, violent capitulation front-runs the timeline. Like if a sudden macro shock drops us to 45,000 next week, you don't sit on your hands refusing to buy just because the calendar still says August.
Right.
The takeaway for the allocator isn't the specific month. It's that the data points to a multi-leg process with another leg yet to come, not a clean bottom today.
Okay, so having established that the bottom is this messy, exhausting process and not a single date circled on a calendar, how do we actually handle this?
Yeah.
Let me propose a mental model that helps me digest this, because otherwise the uncertainty just paralyzes you. We are treating all this data, the 200-week line, the midterm seasonality, the on-chain metrics, like a GPS countdown.
Oh, I see where you're going.
We shouldn't. It is a map. A topographical map shows you the terrain. It shows you the valley where the bottom likely sits, which we are defining as roughly that $50,000 to $62,000 zone. And it suggests the season you might arrive, likely late this year. What a map is definitively not is a timer. It is never going to beep and announce, you're standing on the lowest tick, execute all buys now.
I like that frame. Let's test it. Because the classic mistake an investment committee makes is taking this kind of rigorous data and misapplying it. They hear October, and they treat the map like a strict schedule.
Like a flight departure time.
Exactly. And two things happen. One, they freeze entirely. They refuse to deploy a single dollar until the calendar flips, missing a front-run opportunity. Or two, they get impatient, assume the map is a guarantee, and average down into a falling knife through August and September, destroying their cost basis before the final leg down even hits.
Exactly. They get slaughtered trying to time the clock instead of reading the ground.
A map doesn't dictate the minute of your arrival. A map tells you which valley to watch and what the landmarks on the valley floor look like, so you actually know when you've arrived.
Oh, that's the click for me right there. You navigate by landmarks, not the calendar. The data gives you the zone, roughly 50 to 62K, and the broad window of late this year.
Right.
Your job isn't to guess the day. Your job is to read the landmarks as you pass them. Is price holding the 200-week line on a weekly close? Is the on-chain valuation telling you holders have finally thrown in the towel? You act when enough of those landmarks confirm you are in the valley, regardless of whether that happens in September or December.
It forces the committee to be reactive to the terrain, which removes the emotion of checking the portfolio every single morning.
But since we are relying on a probabilistic map, we have an obligation to vigorously test the extremes. Maps can be wrong.
Oh, absolutely.
If we are briefing an allocator, we must steel man both the extreme bear tail and the extreme bull tail. Let's start with the bear case. I'll give it its absolute strongest form. What is the case that the 200-week line does not hold, the floor caves in, and price goes much, much lower?
You start with the structural bid.
Exactly. Point one for the bears. The bid that defended every single prior cycle was comprised of retail buyers and miners.
Right.
If price drops, the community bought the dip. This cycle is entirely different. It's driven by Wall Street, ETFs, and institutional capital. And as we mentioned, they just ripped a record $3.4 billion out in a single week.
Which is the largest since the ETFs launched.
Right. If that isn't just a temporary pause, but the start of a structural exit by institutions de-risking, then the floor beneath us is completely hollow. Retail does not have the balance sheet to absorb institutional dumping.
The plumbing is fundamentally changed, so the old support might not hold. What's the technical view of the bear tail?
That's point two. The bull market support band has been decisively lost.
Right, let's define that.
Yeah. For the uninitiated, the bull market support band is simply the 20-week moving average, which currently sits way up around $79,000.
Yeah.
In every single prior cycle, holding that band separated a macro bull market from a macro bear market. We are trading miles below it now.
Yeah, we are.
And that leads to point three. The genuine bear scenario. We have to cite Bloomberg Intelligence's Mike McGlone. He models a highly coherent liquidity deflation scenario that takes Bitcoin all the way down to $10,000.
Hold on, 10,000? That sounds like engagement bait for a tweeter.
It sounds like it, I know, but it's not a troll number. It is a mathematical thesis based on liquidity. If the macro environment tightens hard, meaning the Fed refuses to cut, global liquidity shrinks, and we see a massive deleveraging event across equities and real estate, Bitcoin is not immune. If all assets correlate to one in a liquidity crisis, 10,000 is a very real threat.
Fair enough. But intellectual honesty is the brand here, which requires us to defend the bull tail just as fiercely. The bear case sounds terrifying when you lay it out like that, but the data has another side. Let's look at the strongest arguments that the bottom is actually much closer than the bears think. Let's talk about the MVRV-Z score.
Let's define that plainly because it's arguably the single most reliable on-chain bottom signal we have.
Right. The MVRV-Z score measures how far the current market price is from the aggregate cost basis, the realized price of the entire network. Simply put, it compares the market cap to the realized cap to measure the pain or profit of the average investor.
Okay.
When the MVRV-Z score enters its deep green zone, it means the average holder is near break-even or slightly underwater. Historically, this signals massive undervaluation. Forward returns from the green zone have historically been outsized.
So it's essentially the ultimate capitulation gauge.
Exactly. And right now, the MVRV-Z is sitting at a multi-cycle low, squarely inside that green zone. The on-chain valuation is practically screaming that the network is fundamentally cheap, even while the price action looks atrocious.
But wait, what about the $3.4 billion ETF outflow? Doesn't that negate the on-chain metrics if the big money is literally leaving?
Well, you have to look under the hood of those outflows. That selling is highly concentrated in fast money hedge funds and arbitrageurs unwinding basis trades. Meanwhile, look at the sticky money, the registered investment advisor cohort, the people allocating for clients on a 5 to 10-year horizon. They have cut their holdings by barely 6%.
Wow, 6%.
Yeah. The true long-term institutional conviction might be much stronger than the headline outflow number suggests.
So if we have Bloomberg projecting 10,000 on a deflationary bust, and we have the MVRV-Z score suggesting a generational bottom is forming right now, how do we synthesize this?
Well, the honest synthesis is not simply calling down. It is acknowledging the dispersion. Look at the credible institutional targets right now. They span an incredibly wide range, from $10,000 on McGlone's end all the way up to $170,000 to $200,000, which is the fair value modeled by JPMorgan and Tom Lee.
A 10,000 to 200,000 spread among credible institutions. I mean, that width is unprecedented.
And that massive width is the signal. It means we are at a genuine regime decision point. The market literally does not know if it is pricing a deflationary bust or an institutional supercycle.
Right.
The map has a very wide valley. You, as an allocator, must size your positions for that extreme uncertainty. You don't bet the farm on a specific date or a single analyst's price target.
Which brings us to the operational payoff. We've drawn the map, we've outlined the valley, and we've warned of the extremes on both tails. Now, we need to hand you, the listener, the actionable Monday morning toolkit. This is the allocator's reentry checklist. These are the specific landmarks you must see before deploying serious capital.
Right. You don't necessarily need all of these to trigger, but you need a cluster of them to validate the entry. Walk us through the landmarks.
First, we need to secure the price floor. That means a weekly close holding above the 200-week moving average. And I want to emphasize the word close.
Yeah, that's vital.
Intraday wicks, where the price dips to 58,000 on a Tuesday and recovers by Sunday, those do not count. We need a confirmed weekly candle closing above that roughly $62,000 level to prove the structural floor is real.
That establishes the base. But what about the network psychology? How do we know the panic is actually exhausted?
That's the second landmark. The MVRV-Z score turning up and officially exiting its green zone. As long as it is drifting sideways in the green, we are still wallowing in capitulation. When it curves up and breaks out, it signals the capitulation phase is spent and the recovery has begun.
Which naturally leads into the third landmark regarding recent buyers.
Right, reclaiming the short-term holder cost basis. Let's define this clearly. This metric tracks the average entry price of coins that have moved in the last 155 days. It's essentially the break-even point for the cycle's newest tourists. This level must be reclaimed by the spot price. Why? Because when the spot price rises above it, those recent buyers are finally back in profit. That exhausts the immediate psychological selling pressure. When people stop panicking about being underwater, the supply overhang clears.
It allows the relief rally to turn into an actual trend. But for that trend to have legs, we need the big money back.
Which is landmark 4. ETF flows inflecting. We need to see the trend definitively shift from these structural, multi-billion-dollar outflows back to sustained consecutive weeks of net inflows.
Right.
That is the proof required that the institutional bid is actually returned and is absorbing the new supply being mined.
And the final piece of the puzzle to confirm the bear is truly dead.
Landmark 5. Price reclaiming that bull market support band. Getting back above that 20-week moving average, which again is way up near $79,000 right now.
Yeah.
Reclaiming that confirms the macro bear phase is entirely invalidated. You don't need all 5 of these landmarks flashing green tomorrow. But you need a cluster. And each one that triggers is a point you can size a position against.
If we connect this to the bigger picture, the discipline underneath this checklist is the whole point of being an allocator. The absolute bottom of any market is only ever a fact in hindsight. Nobody, not Benjamin Cowan, not us, not JPMorgan, is going to ring a bell at the exact low.
The bell doesn't exist.
It doesn't. And recognizing that is the allocator's edge. You don't marry a date and you don't marry a price. You build the map we just discussed, you watch the landmarks on the valley floor, you scale your capital in as the checklist confirms your thesis, and you always size every single entry to its invalidation level.
Meaning you know your exit before you enter.
Meaning you know the exact price that proves your thesis wrong before you ever put the trade on. That is the exact difference between blindly catching a falling knife and patiently waiting for it to stick firmly in the floor before you pick it up. Bitcoin broke 60,000 today. The data says the valley is near, but probably not fully underfoot yet. Your edge isn't predicting the day. It's having the checklist ready when the day comes.
That's the deep dive. Bitcoin at 60,000, a map to the bottom, and the checklist that turns fear into a plan. This is AION Powerhouse Signal over Noise. Not investment advice. We'll see you in the next one.
That's your AION Investor Briefing. Stay informed every weekday. Subscribe now and download the AION app at aionpowerhouse.com.